bit I can, but go ahead.
Hello, everyone. Thank you for attending our webinar today on saving money on your real estate taxes. My name is Neha Karnwal. I'm a senior accountant with Chugh CPAs LLP in our Cerritos LA office. There are numerous ways in which you can save on your real estate taxes while purchasing a property or selling one or managing your income properties or even buying in a US real estate market as a foreign investor and more. Today, we have a panel of excellent experts providing you an insight on some of those tax saving strategies. Now, before I proceed with introduction of my tax panel and to get into detail, I would like to tell all of you that if you have any question during the presentation today, please feel free to enter them in the Q&A chat box, and we will address those questions towards the end of the presentation. Now, without further ado, let me jump to introduce you to the general panel of tax experts. We've got a great panel of tax experts to share their knowledge today, including Eunice Go, a partner and a CPA, Kapil Handa, partner and a CPA, and Hima Mehta, who is a senior accountant and team lead. Let's dive right in. Eunice, I'll first come to you to discuss that. What do you feel? What are those itemized deductions and how are they so relevant for computation of taxes on real estate?
Thank you, Neha. Good morning, everyone. What are itemized deduction?
Eunice, we are not able to hear you.
Okay. Thank you, everyone. Thank you, Neha. Good morning, everyone. Can you hear me now?
Yes, yes.
Okay. So what are itemized deductions? Itemizing your deduction can help you reduce your tax bill. There are various expenses you incur during the tax year, including real estate-related expenses. When the itemized deduction exceeds the standard deduction, it can make a huge difference in your tax bill. There are some things you need to know about what itemized deductions are and what it means to itemize on your tax return. Itemized deductions are basically expenses allowed by IRS that can decrease your taxable income. The alternate option is the standard deduction, which is a flat dollar amount that reduces your adjusted gross income. For 2021, the standard deduction is $12,550 for single filers and $25,100 for married filing joint returns. You can either take the standard deduction or itemized deduction on your tax return, but you can't do both. It depends on which method saves you more money. One thing to remember when you itemize, you need to be able to substantiate your deductions. That means keeping records and being organized. You need to save your receipts and other proof for your deductions. Back to you, Neha.
Thank you, Eunice. Thank you for that overview. So can a homeowner really deduct interest on a mortgage? Can you elaborate on it a bit, please?
Homeowners who itemize may reduce their taxable income by deducting interest paid on their home mortgage. You can deduct the interest you pay on mortgage every year from taxes you owe on loans up to $750,000 as a married filing joint or $350,000 when filing single. If you buy at the beginning or middle of the year, your first year of home ownership will likely also yield your biggest mortgage interest deduction because mortgages are usually amortized, meaning your interest payments are front-loaded. Back to you, Neha.
Thank you, Eunice. So what about deducting property taxes, Eunice?
Homeowners who itemize may also reduce their taxable income by deducting property taxes they pay on their homes. Eligible deduction include primary home, vacation home, land, property outside the U.S., RVs, and boats. This deduction makes a lot of sense in states with high state and local taxes like California. Because of the Tax Cut and Jobs Act, property taxes are capped at $10,000 on state and local taxes that taxpayer can deduct.
Thank you, Eunice. So as you would know that we get to hear from most of our clients all the time when they buy a property or invest that can they deduct their discount points while purchasing a property. So if you could just elaborate on it a bit.
Yes, when buying a house, it's possible to buy discount points, which are essentially prepaid interest. Just like home mortgage interest, these points can be deducted if you itemize your taxes. Mortgage points are fees paid directly to the lender at closing in exchange for a reduced interest rate. These can lower your monthly mortgage payments. For example, 1 point costs 1% of your mortgage amount, or $1,000 for every $100,000. Essentially, you pay the same interest upfront in exchange for a lower interest rate over the life of your loan. According to the IRS, points can be deducted over the life of the loan or deducted all at once in the year that they are paid. It's also possible to fully deduct points paid on a loan to improve your main home if it meets certain criteria. You have to purchase point when you buy your primary residence. Points must be bona fide discount points. In other words, money you paid to actually buy down your rate. The settlement statement must show the points purchased.
Thank you. So is it same like deducting private mortgage insurance? How does that insurance deduction works?
So deducting private mortgage insurance, which is also commonly known as PMI, PMI is a monthly fee rolled into the total cost of your mortgage, and it's meant to protect your lender if you stop making payments on your home. PMI is usually required on conventional loans when homeowners have less than 20% on equity in their homes. If you itemize your deductions, then you want to claim your PMI premiums if you can, but there are restrictions on who can take the PMI deduction. If your adjusted gross income is over $100,000 for married filing joint or over $50,000 for single, then PMI deduction begins to phase out. Back to you, Nia.
Thank you, Eunice. This was a great insight on various type of deductions available, itemized, standardized, and thank you so much for it. I would like to now move on to Kapil, just to clarify this doubt that we hear all the time, that itemized deduction makes more sense for wealthier individual or for people with higher income. What is your take on this, Kapil?
Sure, Neha. Thank you. Hello, everyone. So yeah, I think the good news is whenever we have a house, so what happens, take an example of somebody have a house of $500,000 in today's rate environment, maybe they are paying 3+%. So rough math, maybe $15,000, and maybe they are doing about $7,000-8,000 on their property tax. So, and then maybe they run some charitable donations of $5,000 or something. So they are able to take a reduction of up to $30,000. I'm just giving a very basic overview, but even though the standard deduction is around $25,000, as Eunice mentioned earlier, I'm taking the example of married filing jointly, but more or less what we have seen practically for most of our clients, when they are owning the houses and and they have property tax, you also get the state income tax deduction. So you're more or less, you end up kind of getting more deductions. So even if somebody is, let's suppose, is in 25% tax bracket and they are able to itemize maybe another $15,000. So, they end up saving 3-4 grand just by electing to choose the itemized deductions. So that's how it works. Neha, back to you.
Thank you, Kapil. So let's shift gears a little bit and try to understand that what options do people have to use their retirement saving while purchasing a home?
So yeah, I think that's a question we get a lot of times. See what happens, IRS gives a sweet gift to all of us that if we are buying our first house, we can withdraw up to $10,000 from our pension account. So again, that first house can be bought today And it's not an annual limit that the IRS sets that I can just take $10,000 kind of a loan from my pension. Actually, I can take it as many times as I want, but there should be a gap of at least 2 years between the first and the second loan. So as long as that is the case, we can do that. And that's how, a lot of people use their retirement savings to get into their first home and pay the down payment.
Great to hear that, Kapil. And we also we hear from a lot of our clients that what is this adjusted cost basis? Why should I care about it? So why should I be aware of it, and how does it help me save my taxes? So it would be great if you could elaborate a bit on this as well.
Absolutely, Neha. So again, at the end of the day, we all have to pay tax on any income that we make. So if somebody has $100 of a property that they bought, and if that property becomes $200 down the road, so that $100 would need to be paid tax on, because that's the difference between my sale price and my cost. So the caveat here is to make sure that we as the customers, clients, individuals are taking into consideration all the costs that we incurred. Of course, we would have the closing document that we bought the house for $100. Maybe there's a $5 closing cost. So my cost basis is 105. But what happens typically, maybe over the years, I bought a house and then I kind of refurbished and created my basement as well. I put some money on my basement. I created some kind of a studio, whatever. That needs to be added to the cost, because that's the money which I put to increase the value, and there was an addition to the home. So let's suppose I put another 25 grand to it. So 100 plus 5 plus 25. So in this case, $130 is going to be my cost. So again, my sale price was 200. So $70 is the gain that I would be paying the capital gain tax on. The only difference we have to be aware of is that there is a difference between improvements and repairs. Most of the time when we live in our houses, maybe in a couple of years, we get the house painted, we have some repairs going on here and there. Those are not the cost that adds to the cost basis. I think that's the point we just want to make sure. But anytime we are trying to add value, add something to your house, just make sure that we have enough documentation that we can claim tomorrow if we are taking and making that addition to our basis. And then when we file the return, we add all that. And if for any reason IRS comes back and asks for explanation, so we make sure that our clients have proper documentation, and then we can justify, and then they end up kind of paying less tax because they took care of all the additions that they made and they had the proper documentation. Back to you, Neha.
Well, that explains why it is so important that to consider home improvements are so critical to kind of adjust the cost basis. Thank you, Kapil. So are there any savings on capital gain taxes while selling home? Or do you end up paying taxes on the entire thing?
Yeah, that's, I think, one of the best things that IRS provided. Anybody who is a married filing jointly, they can have up to $500,000 gain in their house, which will be tax-free right off the bat. Somebody bought a house for $500,000, they sell it for $1 million, married filing jointly. That 500,000 is not taxable whatsoever. We just have to make it half. If the person is single, they get a deduction of $250,000. So I don't know if there's any better way where somebody can be having a $500,000 capital gain and pay zero tax. So yes, that's the provision by IRS, where they encourage people who have put the money in their houses and they end up selling the house. They can always create the equity and walk tax-free legitimately. So that's a great gift by IRS to all of us. Back to you, Neha.
So President Biden has proposed certain changes on capital gain taxes for wealthier individuals or those who will sell high-end properties. So what do you think, Kapil? What is there on the horizon for capital gain taxes?
Yeah, as we all know, right, this is all talk, but I think that directionally we can all see that the taxes are going to go up per our new president. So what we actually foresee at this point is that the individuals who will be making more than $2.5 million, if they are married filing jointly, their capital gain tax, which at the moment they might be paying 20% or 23.8% to be exact, can go up to 39%. So that's the kicker here. So anybody making more than $2.5 million, their capital gain tax can really go very, very high. And yeah, and then the other thing I think what we can see in the new administration is the step-up basis. So I think that's a question we are getting so much from our clients, because many of our clients, they have properties, that is inherited. They have parents overseas. So let's suppose they have a house in India that was bought by the parents for $100, and the same house is worth $500. So when the parents are no more, that $500 is what kind of the fair market value of that house is. The inheritance, when it happens to the client, their cost basis becomes $500. So I think that's a sweet gift where they don't have to pay any tax between 500 and 100 because it was inherited. But we are hearing that might go. So again, if somebody is selling that today, there's no tax whatsoever, but under new administration, they might end up paying tax on that $400 as we discussed.
Understood. Great. So while we have discussed so much on the primary homes, the homeowners, etc., I will now like to move on to the rental properties. This is another talked about topic, and there's so many people who come to us and they want to understand how investment works. So I'll move on to Hima. And Hima, if you could just elaborate and tell us what all deductions could a real estate investor take against its real estate income, that will be helpful.
Sure, Neha, thank you. And hello and good afternoon, everybody. So if you own a property and you rent it to the tenants, so we really want to understand first how that rental income is being taxed. And the basic answer is the rental income is taxed as ordinary income. So for example, you are in the 22% marginal tax bracket, and if you have $5,000 in rental income, you'll pay $1,100 in taxes. However, there are other ways to reduce that rental income. If a profitable rental company can show no income as well, or even a loss on a tax basis. So you don't have to pay tax on all of the rental income you collect. Expenses associated with the property are deductible against the rental income. The expenses must be both be ordinary and necessary in order to be written off. And certain allowable expenses are the cost of cleaning and maintaining a property, the mortgage interest, insurance costs, the money you spend in the case of advertising the property, the payments you've made for anybody managing the property, the HOA fees or the condo fees that you might have to pay, the property tax services you pay for, such as utilities and pest control, landscaping, such things, and other legal and other professional fees related to owning a property.
Thank you, Hima. Thank you for that overview. So that brings me to my next question, Hima, that how can depreciation help those owners of income property save on their taxes?
So you can recover the cost of the income producing rental property through annual tax deductions called depreciation. The IRS defines the depreciation deduction as a reasonable allowance for deterioration, wear and tear, and a reasonable allowance for obsolescence. Assets that have a useful life of a year or more, such as machinery, are deducted over time through depreciation. So real estate investors generally use a depreciation method called the Modified Accelerated Cost Recovery System, also known as MARCS, in which residential rental property and structural improvements are depreciated over 27.5 years, while appliances and other fixtures are depreciated over 15 years. So the depreciation expense often results in a net loss on investment property, even if the property actually produces a positive cash flow. This loss, as well as expenses such as utilities and insurance, are reported on what's known as the Schedule E on the Form 1040 and are deducted from the ordinary income. So if you buy a residential rental property, you can divide the cost of acquiring the property minus the value of the land divided by 27.5 to determine the annual depreciation deduction. So for example, let's say you buy a property for $250,000. The land is actually valued at $50,000, so means that the building is valued at $200,000. So if you just divide that by the 27.5, then you're getting $7,273 per year as a depreciation expense. And that's going to be included with the other deductions discussed previously. And you must stop claiming a depreciation expense after your cumulative depreciation expense add up to your cost basis. So after, for example, in this previous example, the 27.5 years have passed, there will no longer be any more depreciation expense because your property depreciated value is the cost basis.
Thank you. That was quite insightful. So not all our viewers will be aware of tax loss harvesting rules, Seema, and I think those are also critical. So could you just give us a brief primer on what these rules are? Tax loss harvesting.
Yeah, good question. The tax loss harvesting describes the process of reducing tax exposure when selling a rental property by pairing the gains from the sale with the loss from another investment. So this can be a tax planning strategy that is used by investors that hold an investment that has lost value, which is known as an unrealized loss, and decides to sell the asset at a loss in the same year as the gain on rental property sale, which is a realized loss. Although this tax minimizing tactic is primarily used to offset gains from stock investments, more and more people have started to apply it to rental real estate property sales as well.
Great. So would it be wise for some real estate investors to convert their income property into primary residence? What does it really entail?
Right. So I think there are some benefits. So as couple previously mentioned about the $250,000 for single or $500,000 tax-free capital gain in this case of selling an a personal primary residence. So you are able to do that. IRS Section 121 does allow people to exclude up to $250,000 of the profits for single and $500 for married filing joint. To qualify, the investors must own their home for at least 5 years and must have lived in them for at least 2 of those 5 years. Now, the good part is that those 2 years don't have to be consecutive. So you could have lived in the house in the first year of the 5 years and the last year, and you still can qualify for the capital gain tax avoiding, basically. So depreciation recapture is the only thing specific to the rental properties. So the amount previously taken as a depreciation deduction is then taxed at a recapture rate of 25%.
Great, thank you. So we also do hear a lot about 1031 exchanges, as in those like-kind exchanges. So which helps us in save taxes at the time of selling real estate property. So could you just elaborate a bit on this provision?
Yeah, sure. So a 1031 exchange is the 1031 exchange has also been named for the 1031 of the IRS code, which allows investors to defer the capital gain taxes by selling one investment property and using the equity to purchase another property or properties of equal or greater value. The exchange must occur within a specified amount of time. So although a 1031 exchange can broadly include various types of properties, the vast majority of the transactions are related to real estate. From December 31st, 2017, Section 1031, which is also known as a like-kind exchange treatment, applies only to exchanges of real property held for use in a trade or business or for investment other than real property held primarily for sale. So you may have a profit on each swap and you avoid paying the tax until you sell for cash many years later. Then if it works out as planned, you'll only pay one tax, a long-term capital gains at the long-term capital gain rate. So in order to successfully complete the 1031 exchange, you must meet the following criteria. First, the aggregate value of the replacement properties must be equal to or greater than that of the relinquished properties. 2, the properties included in the transaction must be like-kind, meaning real property cannot be exchanged for some other type of investment asset, such as a real estate investment trust. 3, both properties must be held for productive purposes in business or trade or an investment. 4, the amount of debt taken on with the new property must be equal to or greater than the value of the debt retired when the old property is sold. And 5, the investor must use qualified intermediary. The qualified intermediary is an agent who facilitates the 1031 exchange process, largely by holding net proceeds from the relinquished property before they are reinvested in the replacement property. So there are some basic steps for a 1031 exchange. First, the investor must enter a 1031 exchange agreement with a qualified intermediary and put the original property up for sale. While this is in process at the same time, the investor will also begin searching for replacement properties. On the day the investor sells the original property, the net proceeds after paying all expenses are sent to a special account set up by the qualified intermediary. The investor then enters into the identification period and has 45 days to produce a list of qualified replacement properties and 180 days to close on the replacement property during the exchange period. Using the entire proceeds from the sale of the relinquished property, the investor closes on the new investment property or properties. The qualified intermediary wires those funds to the title company, the special account is closed, and the transaction is then completed.
Wow, now I understand why is 1031 exchange so complicated and why do clients come to us. So thank you for that insight, Hima. So while this was very helpful, but I just have last question probably for you, that Biden has proposed certain changes on 1031 exchange eligibility. So how do you think those proposed changes would impact the eligibility criteria?
Yeah, so very important. Biden's proposal would reel in 1031 exchanges on transactions with profits exceeding $500,000. So for example, let's say that there's a dental practice owning a $1.2 million building that it originally purchased for $500,000. Under the current law, the owners can exchange the property for a like-kind office building and defer the taxes by using the $700,000 profit to purchase a new building. However, under the new law, the capital gains tax would be charged for above $500,000 exemption. The new rule could make it difficult for those looking to exchange for a lower maintenance property as they move into retirement. Biden's proposed policy for the 1031 exchange is not law yet. It still needs to be approved by a majority of Congress to become law. If approved, it may change from what is currently the standard.
Thank you. Thank you very much, Hima, once again. So now, since we have discussed about homeowners in US, we've discussed about real estate investors in US, now we can move on to foreign investors in the US real estate market. And Kapil, here I would request your insights of what should foreign national take into account from a tax perspective while investing in a US real estate market.
Sure, Neha. I think this is a question we get so often from our clients because fortunately we work with clients all over, especially Asia and Australia and North America. So they have this question: first of all, the very basic question we come across is, can a person invest in US real estate? And the good news is anybody can invest. So there is no restriction whatsoever. If anybody wants to put down the money in US real estate, US authority says you're more than welcome. So I think that's a very basic thing that our clients ask. But I think where it gets complicated and where we hold the hands of our clients and we add value is how and should I put the money in the US real estate? Should I put it in kind of a corporation? Should I put in my personal name? So those questions we get a whole lot, and I can cover them maybe one by one for the benefit of the viewers or listeners. So again, if a foreign investor, they have few options how they can invest in the US. First and foremost, they can invest in their personal name. I think the question is, when they invest in the personal name, the downside is they expose themselves to a lot of unlimited liability. So that's where they struggle, even though they can do that. And also there's a withholding tax when they buy the property and if there's an income that is generated off it. So that's the thing we have to kind of consider if they are trying to buy it in their personal name. Other thing is they can invest and create a US corporation, and then they set up a corporation, they can own that corporation, and then through that corporation they can invest in their US real estate. So that's totally fine and they can do that. And as long as they are not distributing any profit from that corporation, they don't have to have any withholding. What will happen is that corporation will pay the tax on the income generated, and then anything that is left within the company will be sitting in the profit, which is called retained earnings of the company. So as long as they are not distributing any dividend to the shareholder, which in this case is an investor sitting overseas, so there is no withholding that is required. The only downside when we are setting up the C corporation and investing in the real estate is that the income is kind of, again, all these becomes high tax rates rather than capital gain tax rate. So that's the downside of setting up through the C corporation. Then there is another corporation they can set up. A lot of times that companies, they are foreign companies and they want to set up a branch in the US. They can set up a branch in US and then they can invest in the US real estate through their branch. But again, one of the biggest downsides of that is not only they have to pay the US corporate tax rate, which is flat 21% as of today, and probably will go up. They also have to pay 30% foreign branch tax. So that's the killer. So again, that's not a very good thing to do. I think one of the hybrid model, which is not very well known in the maybe investment world, is the US blocker structure, US blocker corporation. So I think the question is, what is a US blocker corporation? It's none other than a C corporation, again, US blocker corporation. What happens in this situation is the investor, let's suppose, who is sitting in India, they invest in this blocker corporation, and this corporation further invests in the LLC in the US real estate. So typically what we have seen is in the US, the real estate entities typically have a LLC structure. So these US corporations, then this blocker corporation can invest in those entities. And the whole purpose of doing all this and kind of creating another layer is that at the end of the day, whenever the property is sold by the LLC of the real estate, that gain kind of is taxed as a capital gain tax rather than the ordinary tax, which is not the case in the other, regular C corporation. But again, I thought that's the overview. Sorry to keep it long, but back to you, Neha.
Thank you for providing that overview on the ownership structure as well, Kapil. And I can understand you cannot summarize those structures over a webinar just in 2 minutes. But I'm sure at least our audience would have got a glimpse of how it can work. Now, moving on to the other question that we hear a lot is that what are some ways that individuals can save money when estate planning with regard to the real estate holdings?
So yeah, estate planning, again, as of now, we have $11.7 million per person limit that each individual have. And if you are married filing jointly, you can double it up. So that's a very, a decent amount with which most of the people can use. And as long as you are within that range, you can pass on that properties, that estate to your next generation without any tax whatsoever. However, I think the caveat here is if somebody's, can plan that around, again, estate planning, inheritance sometimes is subject to death, which we can't plan much. But, given how the Biden administration is trying to reduce that $11.7 million may go back to pre-Trump area where it was more like in 5 million range. So that can go down. So people with a decent net worth, that's the kind of a downside. They might be now, their estate might be taxed if it goes beyond 10 million or so. But again, this is all in works, but looks like that's the direction at this point. Back to you, Neha.
Thank you. So since you've touched upon Biden's, this American Families Plan proposed changes, so what do you think, if these changes really, if the proposal really does go through, then how can it affect an individual's plan how can an individual plan for these potential changes, the affected ones?
Yeah, I think that's where, I think they need to really get in touch with their, specialized CPAs. I think we are helping most of our clients right now. And again, since we know the tax rate directionally is going to go up, one thing, just for the sake of example, is if they are sitting up with a lot of gains in their capital markets, maybe they invested a lot of money in the US stock market and they're sitting in some decent gains, maybe they want to sell some of it, cash it out, pay the tax at the current rate, which is relatively lower, and then keep the remaining one and then kind of do that in the following years. That's one strategy they can make. Other thing they can really do is, a lot of times companies have the executives, or a lot of small businesses are they are the executives, they are the owners, they are the people who run everything. So they have the option of running the bonuses, they have the option of how they can reward themselves. So they might want to get aggressive and then kind of keep those incomes for down the road. Let's suppose if somebody was going to pay $100,000 to their executive in 2021, maybe they want to pay that in 2022, so that the taxable income in 2021 is higher, because we know that the tax rate is relatively lower in 2021. So keep the income higher in 2021 and shift the expense to 2022. And then kind of, if that is the case, if the tax rate goes up, we end up paying less tax. Those are the brief strategies that we can play around, but I think we have been in constant touch with our clients, and yeah, that's the strategies we are working, because in this next 2-3 months we see a lot of queries, we see a lot of questions from the clients.
Understood. It gives a good perspective, at least we know where we are heading towards. So this brings us to the end of our presentation for today. And if I would urge all the audience, if you haven't already entered your question in the Q&A chat box, then please go ahead and put your questions. In the meanwhile, we'll go through the questions that we've received so far, because we have time for Q&A. I do see I have got one question that says, can I get any tax benefit for my secondary residence as well? Kapil, I think you can take this.
Absolutely, Neha. So yes, any person can take the deduction for up to 2 houses. So that includes primary and secondary. And I think the only thing we have to make sure is the deductions again are subject to $750,000. So person might have three homes, 4 homes, but the interest deduction that the person can get is up to $750,000 of the mortgage loan. The houses can be worth $2 million. But the interest deduction the person will get is up to 750. But yes, the answer is they can get the deduction both on primary and secondary house, Neha.
Thank you, Kapil. Another question is, would you please provide list of expenses you can claim as itemized deductions on 2020 tax returns? Eunice, to you, please.
So on the itemized deductions, you can claim medical expenses, but there are limitations. You can only deduct the medical expense amount that exceeds 7.5% of your AGI. Let's say your AGI is 40,000 and your medical expenses is 5,000. As a result, you can claim 2,000 on your tax return. How to calculate is 40,000 AGI multiplied by 7.5% is 3,000. Then the excess is 2,000, which is 5,000 minus 3,000, and you can claim that 2,000 as medical expense. And then another one is the taxes you paid, which is state taxes and local taxes and property taxes. You paid, but that amount is capped at 10,000. And previously mentioned is the interest payments that you made on your mortgage, for up to 750,000 for loans and 350 for single. Another one is the interest on home equity debt. That one, because of the TCJA, that you cannot claim the up to 100,000 home equity debt from 2018 to 2025. Another one is charitable contribution, which is whatever cash donation to public charity, but it cannot exceed 60% of your AGI. And then another one is the casualty and theft losses. This one is also removed with the TCJA from 2018 to 2025, but they allow if it's declared federally disaster by the president. For job and miscellaneous deduction, this was eliminated as well. And the total itemized deduction, there are no limits for tax year 2018 to 2025.
Thank you, Eunice. Thank you. I have got another question for Hima. And they have asked that would an exchange of a primary residence with rental property be deemed as a like kind or 1031 exchange? Hima, what is your view on this?
Yeah, so Neha, I think that's definitely doable as long as it is a like kind exchange and it's related to the rental as well. So not your primary residence, but if it's real estate related, then yes, you could definitely do the 1031 with it. Great,
thank you, Hima. Eunice, I have another question for you. Is the mortgage interest and real property tax I pay on a second residence deductible?
As Kapil previously mentioned, yes, you can claim the mortgage interest for a second home, but subject to limitation, which we already mentioned, the 750 and the 350 for a single. And then for the property taxes, you can, but it is capped at 10,000.
Great. Kapil Bhai, you have already answered this question, but I will still kind of relay it to you. Can foreigners own US real estate? Also, what are the challenges they might encounter?
Sure, Neha. Again, I think, yes, the good news is anybody can own a real estate in US. But practically what we have seen, the struggles that the clients have is, a lot of time they have a strong backing overseas, but when they come to a foreign land, US, they don't have any history. So let's suppose they have to buy some real estate. The biggest challenge is to get the loan. So all the people who are residents in the US, they always can get loan up to 80-90% of the value of the asset. But typically the foreigners, they really have to start with putting all money down as equity. But the good news is as they progress in their journey, and that's the practical example we have seen with few people, then they are able to build up the history in the US. And then in few years, they are able to get loans. And other thing, practically people from Canada, even if they don't have history in US, we have seen they are able to get some loans because there are banks like RBC, that is a Canadian bank, but they also have branches in US, in New York. So the person have the history in Canada. So in developed world, especially North America, we have seen those things happening. But yeah, there are some hiccups, bumps, but over the time, I think it gets smoothens out. That's how it works, Neha. Back to you.
Thank you. Thank you, Kapil. This is the last question I see so far, unless we get more while Hima answers this. So Hima, this question is for you. Can I take advantage of a 1031 exchange if I want to acquire a replacement property in a different state than the relinquished property is located?
It's a good question. So yeah, exchanging properties across state borders is a very common thing that investors do. In fact, a great number of our clients do exactly that. It is important to recognize that the tax treatment of interstate exchanges vary with each state, and it's important to review the tax policy for the states in question while making this decision.
Thank you. Thank you, all of you. If you have not already answered, if you've not already asked any questions or entered your question in the chat box because you think, there is a lot to digest because there's so much going around real estate, especially during this time when it's a hot and a booming market. So you please feel free to reach out to us or schedule a consultation. You can email your questions at info@chugh.com or email one of our presenters directly using the contact information of our presenters. Also, I believe that we have a lot of material on our website, be it business related and even COVID-19 resources. Please feel free to visit our website, which is www.chugh.net, which is CHUGH, and feel free to review and let us know your feedback or anything that you need around it. We also recommend if you could subscribe to our YouTube channel because there are great business insights and business content each week. And we conduct webinars each month. Feel free to register on our website. Thank you all again for attending the session. If there are no more questions, then we would probably end the session now. Wish you a safe and a happy week ahead.
Thank you, everyone.